Hello, in this lecture we will define book value. According to Fundamental Accounting Principles, WOW 22nd edition, the definition of book value is assets acquisition costs less its accumulated depreciation or depletion or amortization, also sometimes used synonymously as the carrying value of an account. Thinking about book value means we need to know some terminology. We need to know what types of accounts are typically depreciated or depleted or amortized. We need to know why. We need to know what depletion is, what depreciation is, what amortization is, in order to know the calculation in terms of how to get to book value and what that book value then means. So if we take an example of, in this case, the property, plant, and equipment of a tank, the tank here is going to help our business in order to help us generate revenue in the future. And therefore, we're going to put it on the books as an asset. So we put it on the books at cost, $257,500. It will go down in value over time. However, unlike something like supplies, it will not be going down in quantity, meaning we will still have one tank, but it will be worth something less than the $257,500. And therefore, we need to find some way to allocate that cost, reducing the value even though we still have the same number of actual physical assets there. In order to do that, we calculate the depreciation. So we have accumulated depreciation right under this, meaning it's a contra asset account, therefore telling our readers two things. One, what the cost of the equipment is, and two, what the estimated decrease in value or allocation of cost is over time. Therefore, the book value will be this $257,500 minus the accumulated depreciation. How would we calculate that? One way, the most common way, the baseline way, is the straight line method, taking the cost minus the salvage value, meaning the value that we think we can sell the tank for at the end of the useful life, bringing us the amount that we believe should be depreciated over the useful life, and then allocating that useful life, dividing by the useful life, in this case of 4 years, the life that we believe that we were going to use this asset for in order to help us generate revenue in, that giving us a straight line depreciation of $59,375, even depreciation per year in this case. Therefore, if we were to calculate the first year and then record and post the first year, we would have the equipment on the books at $257,500, accumulated depreciation $59,375. Book value then would be the estimated value of the equipment on a book basis, being the $257,500 minus the $59,375. We are able to tell our reader a couple different things through this depreciation method: the cost, the allocated cost over time, the decline in value according to the method used, and then of course the book value through the calculation of the $257,500 value cost minus the accumulated depreciation of $59,375 in this case. If we look at it in table format, we can see that depreciation for year one is that $59,375. The calculation of the book value then would be the cost, $257,500, minus the accumulated depreciation, giving us the book value. In year two, what would happen? We would depreciate the same amount. The cost would be the same, but the accumulation would go up by the amount of depreciation that has accumulated. Year one, $59,375, plus year two, $59,375, bringing us to $118,750. The $257,500 cost minus the $118,750 brings us to the book value of $138,750 book value end of year two.